The first thing you need to accept is brutal. In a real 50% stock drop, gold and silver don't behave like a movie prop that levitates on cue because the first enemy isn't fear. It's cash, and cash demand doesn't negotiate. People will tell you safe haven like it's a spell. Meanwhile, the market is running a margin engine in the background, and it sells what it can, not what it wants. And that's where the real pressure starts. Here's the sequence nobody wants to say out loud. A 50% drawdown isn't one event. It's a chain reaction that moves through 3 phases, and metals can look wrong in phase 1, even if they read perfectly right for phase 3. If you don't separate the phases, you'll read the tape backwards, panic at the exact wrong moment, and then spend months telling yourself you were early when you were actually just undisciplined. But the next detail is what flips the whole setup. Phase 1 is the liquidity smash. It's the moment everything becomes collateral, and the only question is what can be sold right now at scale. Not what's undervalued, not what's supposed to hedge, what can be turned into cash before the close. This is when you get the dash for cash dynamic, where even good assets can get clipped because the system is trying to meet obligations. This is also why you sometimes see gold wobble or dip alongside stocks early on. And if you don't understand that, you'll mislabel it as gold failed. No, funding stress showed up. That's different. So what's the mechanism? It starts with leverage and it ends with forced behavior. When equities crater, volatility spikes. When volatility spikes, risk models adjust. When risk models adjust, margin requirements rise. Lenders get tighter and positions that looked fine yesterday become toxic today. That means hedge funds, risk parity, vol control strategies, and even conservative multi-asset portfolios are told, in effect, to reduce exposure. And reducing exposure isn't a philosophical debate. It's a sell program. Now zoom in. Imagine a portfolio that's long equities, long credit, and also long gold as a hedge. The equities gap down, credit spreads widen. The portfolio gets margin calls or redemption pressure. What do they sell? Often they sell the thing that still has a bid in a deep market. Gold futures are liquid. Gold ETFs are liquid. In the opening phase of panic, gold can be a source of cash, not because the hedge is wrong, but because the hedge is liquid. That single sentence explains an entire month of confusion in a crash. And that's not the part that matters. What matters is what happens next, because phase 1 is about funding, not value. Phase 2 is about policy and stabilization attempts, and phase 3 is about trust and solvency repricing. Metals tend to do their real work in phase 2 and phase 3, but only if the plumbing doesn't seize up entirely. The reason I am being so specific is because it gives you a roadmap instead of a vibe. And the market punishes vibes. Let's make it real. Right now, gold has been trading in the mid 4600s per ounce recently, with attention on the upper 4600s area as a recent peak zone. Silver has been hovering in the low 90s, with spikes toward the mid 90s. If you're watching ETFs, GLD has been living roughly in the low 420s neighborhood, and SLV around the low 80s. Those are not magic numbers, they're reference points. In a crash scenario, what matters is how price behaves around prior breakout zones, panic wick lows, and reclaim levels, because those are the points where participants are forced to act. Because if this one level breaks, the math changes. Now, I'm going to give you the hidden detail that reframes the entire get gold and silver in a crash argument. And it's not a conspiracy, it's not a slogan, it's market structure. The price you see on your screen is often the loudest number, not the tightest constraint. In stress, the real price discovery shifts into spreads, availability, and who can actually source metal without paying up. In other words, the spread is telling the truth. And when that spread starts screaming, you get a different kind of move than the one people expect from headlines. But that's not the part that matters yet. First, you need to understand what breaks in phase 1. It's not the metal, it's the funding chain. The market is basically a web of promises backed by collateral. When volatility erupts, the web tightens, haircuts go up, dealers pull back, repo gets more expensive, bid-ask spreads widen, liquidity thins, and the people who thought they were investors discover they were running a financing operation. That's when you see selling that looks irrational, because it's not about opinion, it's about survival. Here's the key. In that phase, correlations go to 1 because everybody is selling at once. It's like a crowded theater with one exit. It doesn't matter what you're holding if you need to reach the exit. The first minutes and days of a true waterfall are not a referendum on the long-term thesis for gold or silver. They are a referendum on who is overlevered and who can keep funding their book. And this is where silver becomes the most misunderstood asset in the room. Silver is the metal with 2 faces. One face is industrial demand. The other is monetary reflex. In the first wave of a crash, the industrial face can get punished because the market starts pricing recession, demand destruction, and collapsing manufacturing activity. That's why silver often underperforms gold in the earliest panic. It's not because silver isn't money, It's because silver is also a cyclical input, and the market is trying to price the hit to growth. But the next detail flips it. Because when policy response shows up, rate cuts, liquidity injections, whatever form stabilization takes, silver can turn into a high beta expression of the same monetary impulse that drives gold. If gold is the anchor, silver can be the sail. It catches the gusts, and that's where the real pressure starts, because the sail can rip higher fast when positioning is wrong and the market is underhedged. So you've got two metals, two behaviors, three phases. Now let's talk about the calendar, because the calendar is the catalyst, and most people treat it like trivia. Crashes do not glide evenly. They cluster around forced windows, month-end rebalancing, quarter-end reporting, option expiry, futures roll windows, delivery periods, policy meetings. Those are not just dates, those are deadlines. Deadlines force flows, and flows move price more than opinions do. If you want to know why this week matters more than some time, you watch the calendar. Because if the market hits a forced window while liquidity is thin, like heading into a weekend or into month end or into a major options expiry, the market can gap, and gaps don't give you a second chance. Now I am going to explain one mechanism that most retail investors ignore and then blame on manipulation when it bites them: dealer hedging and options reflexivity. When volatility rises and big option strikes come into play, dealers who sold options have to hedge their exposure. If clients are buying puts in equities, dealers are short puts, and they hedge by selling futures or stock. That selling can accelerate the drop. Meanwhile, as the market falls, the delta of those puts increases, which forces more hedging. That's a feedback loop. Same idea can apply in metals if you get heavy options positioning around key strikes. This isn't a secret cabal, it's risk management, it's math. And here's the payoff. This mechanism can temporarily crush everything in phase one, including gold and silver, because it's not about which asset should win, it's about which positions need hedging and which markets can absorb flow. But when the hedging flow exhausts or flips, when dealers go from short gamma to long gamma, when volatility stabilizes, when the market stops free falling, you often get violent mean reversion and then the next leg. And that's where the real pressure starts. Okay. So how do you know which phase you pour stills Rowari in while the tape is trying to hypnotize you? You use proof points, not one, a stack. Because one indicator can lie, 5 together tell a story. Proof point number 1, term structure and spreads. In metals, watch whether near-dated pricing starts to behave differently than longer-dated pricing. You don't need to become a derivatives wizard to get the implication. If the front end starts getting bid relative to the back end, it can hint at tightness or urgency. If everything is in contango and the curve steepens under stress, that can reflect funding and carry dynamics dominating. Either way, the curve is a confession. But that's not the part that matters alone. Proof point number 2, inventory signals, but with a critical nuance. Inventory is not one number. There are categories. There is capitalist metal exists somewhere, and there is a metal deliverable into the mechanism that sets the reference price. Those are not the same thing. In stress, what matters is the deliverable pipeline, what can be moved, refined, assayed, and delivered into the channels the market uses for settlement. If reported deliverable stocks tighten while demand stays firm, spreads can react even if spot looks sleepy. And that hidden detail is exactly how price can lie while access tells the truth. Proof point number 3, import to not export behavior and premiums. If you hear about rising premiums, longer delivery times, or unusual demand from particular regions, that can be a street-level symptom that physical flow is tightening. You don't need to treat every anecdote like gospel. You treat it like smoke. If you also see the curve and spreads respond, that's when the smoke becomes a signal. The next detail is what flips the whole setup. Proof point number 4, positioning. When you get a crash, there are shorts, there are longs, and there are people who thought they were neutral but aren't. If you see signs that shorts are crowded and the market stops falling, you can get short covering that fuels a fast rally. Short covering isn't bullish sentiment. It's buying that must happen because risk limits are hit. That's why squeezes feel unfair. They aren't votes, they're forced exits. Proof point number 5, cross-market comparison. Watch gold versus silver ratio behavior. Watch gold against the dollar, watch metals against real rates expectations, even loosely. If equities are down hard but the dollar is also spiking, metals can struggle early. If the dollar squeeze relents and inflation expectations start firming, metals often find their bid. That's the phase change. That's where the real pressure starts. Now let's talk about what institutions actually do, because this is where retail narratives usually collapse. ETFs and futures don't think, they transmit flows. In a crash, ETF holders can redeem. That can pressure spot-linked vehicles. CTAs and systematic trend followers can reduce exposure or flip direction based on their signals. Banks and dealers manage inventory and hedge risks. They don't want to be heroes. Central banks, when they're involved, tend to move slowly and steadily, not like day traders. And the crowd? The crowd buys and sells based on emotion, and emotion is always late. So in a 50% drawdown, you get this tug of war. Forced selling and funding stress on one side, then policy response and the hunt for safety on the other. Gold sits closer to the safety pole. Silver sits closer to the cyclical pole until the monetary response hits, then silver can whip to the other side like a pendulum. And here is the trick, the safe haven. Trade usually works best after the first liquidation wave, not during it. That single idea saves you from the most common trap, which is buying the first dip with too much size, getting shaken out, then refusing to re-enter because your ego is bruised. That's how volatility farms you. Which brings me to the viewer psychology shield, because if you can't control your behavior, none of this matters. Volatility doesn't just move price, it edits your memory. You'll remember the top tick you didn't sell. You'll remember the wick that stopped you out. You'll ignore the slow grind that actually built the move. Headlines will tell you a story that fits the last hour. Your brain will treat the last hour like it's the whole world. And that's how people get emotionally manipulated into buying strength and selling weakness, even when they swear they're long-term. So here's the shield, separate trend from noise. Noise is intraday whipsaw, gap fills, and liquidation candles caused by forced flow. Trend is the sequence of higher lows, reclaiming key zones, and spreads staying firm while spot consolidates. Noise tries to scare you. Trend forces institutions to reposition. One is theater, the other is plumbing. But the next detail is what flips the whole setup. Now let's put this into a practical near-term roadmap for right now, because you're not here for philosophy. You want what matters this week, what matters next week, what breaks the thesis, and what confirms it. Start with gold. If gold is around the mid-4,600s, the key concept is this. In a crash, gold doesn't need to sprint higher immediately to be bullish. It needs to hold its structure under stress and reclaim quickly after liquidation hits. Watch the prior breakout zone and any recent swing low zones. If gold gets hit in a liquidity wave and then snaps back above those zones with conviction, especially if spread as an availability indicator stay firm, that SA tell. It says, forced selling happened, but the bid is real. If gold breaks those zones and can't reclaim them, that's your warning that funding stress is still dominating and you might not be out of phase one. Now, silver. If silver is around the low 90s with spikes toward the mid 90s, silver's job in a crash scenario is usually to first survive the industrial fear, then reprice as a monetary high beta once the policy response and inflation expectations get louder. Watch whether silver undercuts a key support area and instantly recovers, or whether it bleeds and can't bounce. Silver's volatility is not a bug. It's the feature. It's also the trap. If you were using ETFs as a reference, GLD living around the low 420s and SLV around the low 80s tells you the same thing. These vehicles can reflect flows quickly. In phase one, they can get hit. In phase 2 and 3, they can become the easiest on-ramp for broad capital. Your job isn't to worship the ticker. Your job is to read the behavior around levels and flows. Now the calendar trigger again, because this is where traders get blindsided. As you approach month-end or major expiry windows, positioning and hedging can intensify. Liquidity can thin. That S when you see random spikes or dumps that aren't T-random at all. They're forced hedges, rebalances, and roll-related flows. If you know a window's coming, you don't have to predict the direction to benefit. You just have to respect gap risk and size accordingly. Because if this one level breaks, the math changes. Okay, 2 scenario lens. This is how you keep credibility and avoid hype, because the market doesn't reward certainty. It rewards preparation. Scenario 1 is the controlled pullback and retest. Equities drop hard, funding stress spikes, metals wobble, then the system stabilizes. Policy response is credible enough to calm the plumbing. In this scenario, gold grinds higher after the initial liquidation, and silver lags then catches up. You'll see it in reclaim behavior. You'll see it in spreads staying relatively contained. You'll see it in volatility cooling from the extremes. Your checklist here is simple. Does gold hold its key structure? Does it reclaim quickly after flushes? Does silver stop making lower lows and start basing? Does the dollar squeeze ease? If yes, you're likely moving into phase 2. Scenario 2 is the continuation squeeze with gap risk. Equities keep sliding, liquidity continues thinning, and funding stress keeps forcing selling. In this scenario, you can get violent moves in both directions in metals, down because cash is king, then up because trust is collapsing, and the market is repricing policy credibility. This scenario is where you get the paper price looks calm, but access is tight, dynamic. It's also where short covering can hit like a lightning strike. Confirmation here is uglier. Repeated failed bounces in equities, persistent high volatility, and signs that policy response is lagging the problem. If you see metals get slammed and then instantly rebound in the face of bad news, that's a clue that selling is being absorbed. But if metals keep breaking and can't reclaim, you're still in the funding vice. Now let's revisit the hidden detail with more force, because this is the part that separates serious investors from headline tourists. In stress, the market can show you one price, while the real constraint lives elsewhere. If spreads widen, if near-term urgency shows up, if deliverable channels tighten, if premiums rise, if physical availability becomes a conversation, that ES, when the market is telling you the price on your screen is not capturing the full story of access and urgency. Again, you don't need to turn this into a comic book plot. This is simply how markets behave when the physical chain has friction. And yes, the supply chain matters. Refining and logistics are boring until they aren't. Metal doesn't teleport. It needs to be refined, assayed, transported, and allocated. Bottlenecks don't need to be catastrophic to matter. They just need to be tight enough that marginal demand has to pay up or wait. And when marginal demand is institutional sized, wait becomes bid. But that's not the part that matters. The part that matters is what it forces participants to do. If you're a dealer and you see tighter availability, you manage risk differently. You widen spreads, you quote more cautiously, you hedge differently. If you re-fund and you see that a safe haven interest is rising while equities are still unraveling, you start thinking about duration, inflation expectations, and reserve assets. If you're a manufacturer that needs silver as an input, you don't care about the narrative, you care about procurement. You lock supply. That procurement can become demand that doesn't disappear when price dips. It becomes a floor. Now, let's talk about the institutional conflict, because the opening verdict isn't just drama. There really is a force that tries to suppress or deny the move, and it's not a shadowy villain. It's incentives. Institutions hate disorder. They hate volatility spikes. They hate narratives that encourage people to exit traditional assets en masse. They prefer the story that everything is contained, liquidity is fine, and the system is stable. That's not evil. That's risk management. But it means that during the early phase of a drawdown, you'll hear soothing talk while the plumbing is screaming. And you'll notice, I'll see analysts argue about whether gold is working because it dipped 2% in a liquidation wave. That's the misdirection. If you're only watching the headline number, you'll think the metal failed. If you're watching the mechanism, you'll realize the system is selling liquid collateral, and that as often the prelude to the phase where metals get bid for what they are, trust assets and monetary hedges. The next detail is what flips the whole setup. So what do you watch next week? Here's your checklist, and I want you to treat it like a pilot checklist, not a horoscope. First, watch equity volatility behavior. Is VOL still rising aggressively, or is it starting to stabilize? Stabilization doesn't mean bull market. It means the forced hedging loop might be easing. Second, watch the dollar stress behavior. If the dollar is in a squeeze and continues to spike, metals can remain choppy. If the squeeze eases, metals often breathe. Third, watch metals around their key reclaim zones. For gold, after any flush, does it reclaim quickly and hold? For silver, does it stop bleeding and start building a base, or does it keep breaking levels with no response? Fourth, watch spread behavior and any signs of tightness. Again, not a conspiracy, a symptom. If you see repeated signs that access and urgency are diverging from the headline spot, that's meaningful. Fifth, watch positioning cues and who is forced. When you see a move that makes no emotional sense, like a sharp metal rally on terrible equity headlines, ask yourself, who was short and just got forced out? Who needed to hedge? Who needed to rebalance? Forced flow is the hidden hand that you can actually understand because it leaves footprints. Now the risk framing, because if you skip this, you'll become the person who was right, but lost money anyway. Price can whip around violently even if the thesis is correct. In fact, the more correct the long-term thesis, the more aggressively the market can use volatility to shake out weak hands in the short term. The market will try to make you feel stupid for being early and then make you chase when you curve and relate. If you don't plan for that, you'll turn a good thesis into a bad trade. So size matters, time horizon matters, and most importantly, define invalidation. Invalidation isn't, it went down today. Invalidation is the structure broke and didn't reclaim, the confirming signals disappeared, the spread behavior flipped, or policy response changed the regime. Like without invalidation, you're just reacting to emotion. And here was a clean way to hold your mind steady. Treat metals as a regime indicator, not a lottery ticket. Gold is telling you something about trust, reserves, and monetary psychology. Silver is telling you something about cyclicality colliding with money. In a 50% equity drawdown, those signals can get scrambled in phase 1 and become crystal clear in phase 2 and 3. Now let S connect the dots and give you the concrete payoff I promised at the start. What really happens in order, and what breaks if X happens. In the opening wave, equities drop, volatility spikes, and funding tightens. People sell what's liquid. Gold can dip. silver can dip harder. Headlines declare the hedge failed. That's the misread. Then policy response grows louder, or the market starts anticipating it. The dollar squeeze can ease, risk models adjust, forced selling slows. That's when gold often starts acting like gold again, less because everyone believes, more because the marginal buyer returns and the forced seller steps back. If the stress is severe, physical signals and spread behaviors start to matter more. Access becomes a theme. Then as fear shifts from liquidity to solvency or credibility, metals can reprice in a way that feels discontinuous. Gold can trend, silver can snap. Not because of emotion alone, but because of positioning, hedging, procurement behavior, and the fact that once a line breaks, the market can't unsee it. What breaks the thesis? If funding stress stays dominant and metals cannot reclaim key zones after repeated flushes, if spreads don't indicate tightness, if policy response restores confidence cleanly, and real rates expectations rise in a way that undercuts metals, then the metals explode while stocks collapse story becomes weaker. You don't need to be dramatic about it. You just need to be honest. What confirms the thesis? Metals getting hit and then refusing to stay down. Quick reclaims, firm spreads, persistent demand signals, a market that can't stabilize without throwing more liquidity at the problem. Those are confirmations, not a single green candle. And one more thing, because this is the quiet truth most people ignore. The biggest risk in a crash isn't T picking the wrong asset. It's being emotionally gamed into abandoning your process. Volatility will use you if you let it. It will show you a red candle and make you feel like the world ended, then show you a green candle and make you feel like you missed salvation. Neither's true. It's just the market hunting weak positioning. So when you watch gold in the mid 4,600s and silver in the low 90s, don't ask, will it moon? Ask, what phase are we in and what is the market forcing participants to do? That question keeps you in reality. And here's the subtle thing I'll ask from you, not as a plea, but as a filter. If you're the kind of person who wants mechanisms, not slogans, and you actually want to build a shared language for what to watch when things get ugly, stay close to this corner of the community. Not because anyone has a crystal ball, because we're building a map. And in a storm, a map beats a mood every time. Now you've got the playbook. Liquidity first. Then policy. Then trust. Watch the calendar. Watch the spreads. Respect the phases. And when the market tries to bully you with volatility, remember, the loudest price is not always the truest signal. And the next detail is usually where the money gets made.